Hi, this is Michael Carlin, president of Henry & Horn Wealth Management with your fourth quarter market outlook. And we are fortunate again to be joined by my friend and colleague, Joe Tiber. Joe, good morning. How are you?
Good morning, Michael. Thanks again for having me.
And thanks for calling from Dallas. I appreciate it. I know you got a super busy week, and the market continues to move. Economic data continues to pile in. So listen, without further ado, why don't we just go ahead and jump in? We're recording this in early October. I found an interesting quote. I thought you'd like it, Joe. I thought of you when I read it. It said, October, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. Mark Twain said that. I don't know. You're a student of history. A lot of people think, Joe, that, October, they're thinking of, some of the, the market crash of 87. They're thinking of difficult market environments. And my experience in the 24 or 5 years I've been doing this is that it's just like any other month. So I'm not expecting anything particularly gloomy because it's the Halloween season. Are you?
No. I mean, this is a Mark Twain quote. It could also be a Yogi Berra quote.
I know. Yeah.
But the one number I will throw out, because there is some truth to the urban legend of October, and that is just looking at the market. The fact really is that October, for whatever reason, historically has been a more volatile month. The average intra-month spread of high to low in the S&P 500 goes all the way back to the 1920s has been 6.41%. And October is a standout higher vol month, which is 8.25%. So you get about 25% more volatility in October. But that said, as with everything in this business, history definitely is no guide for the future, and it certainly is not an investable thesis by any stretch.
Right, because maybe that volatility is part of what gives people the inclination or belief or fear that October is going to be spooky for some reason. So the question is that, we are some 3% away or a little bit more than that as we sit right here today from the top. And what we're, constantly trying to figure out is, whether or not we are at the top. We did make some adjustments to our portfolio when the market reached its highs in September. We did take our stock exposure down a little bit across the board. And we do that because what we always try to preach to clients is that we do work hard to try to buy low. We do work hard to sell high. Not that we're calling a market top, because when you look at a lot of the key indicators of what you'd be seeing, and I'm just going to roll through a few. I mean, you're looking for that kind of that blow off top, that massive amount of speculation that drives the market incredibly high quickly. We don't have that. Have there been heavy inflows into equity funds? No, we have some data on that. No, the equity, there's been, in fact, it's been remarkable how much money has come out of certain parts of the equity market. There's been a little bit of a pickup in M&A, but by historical standards, mergers and acquisitions, it hasn't been all that crazy. IPO activity's been okay. Of course, it's headlined by Uber and Lyft's disastrous performance and its release, in Peloton more recently was pretty underwhelming as well. Do you have rising real interest rates? In fact, no. We've got quite the opposite. We've got the Fed helping us. Earning revisions. Are they weakening upward earning revisions? No, in fact, the third quarter is looking a little weak. And as you go through each of these points, Joe, to me, we don't have the classic signs of a market top, right?
Yeah, no, we'd agree. The asterisk I would add to that, we definitely see eye to eye in terms of the forward runway. The only thing I'd add to that is that does not mean that there's an absence of volatility potentially, right? Because the market's definitely and has been and will continue to be tethered, to the two primary drivers, both of which are more, I guess one of which is certainly more top-down, but the trade conversation is definitely dominating. Risk sentiment is number one. And then number two, just sort of where global growth sits, looking at Europe, looking at the U.S., looking at China, and hoping for a global growth rebound. So those are the two drivers. We're constructive on both of those two, longer and intermediate term, but
Right.
here in the near term.
And for those of you that are regular listeners of this podcast, and thank you, we know that there are many of you. We've carefully used this word constructive now for the past number of quarters. So if you're looking at your relative stock exposure, with us, and if you're looking at it yourself, again, we're gonna use that word constructive, which is maybe this is the way I position is that you want to have some equity exposure, but less than normal. Whatever that normal rate is for you individually. And again, if you need some help, reach out to us. We're happy to let you know where we think you need to be. Earnings growth estimated to be negative for third quarter. So let's just kind of reiterate again, year over year, quarter over quarter, the third quarter expectation for the S&P 500, the big 500 U.S. blue chip stocks in the United States, is slated to be negative 3.2%. That is really negative. And we just finished the third quarter. We're going to start getting corporate earnings here soon. From what I can tell, the indications that I'm getting is that, maybe that 3.2 is a little bit too negative, which leads us open for the possibility of upwards earnings surprise. But before anyone gets too excited about, upwards earnings or massive earnings expectations, you look at a year like 2018, and corporate earnings were far and away greater, great growth, 20%, 25% growth in 2018, seemingly quarter after quarter, but the stock market didn't perform. Here we are looking at a negative potential third quarter number. I think we might be able to perform better than that, but that doesn't always necessarily mean that the runway is clear for the stock market to go crazy higher. Is there anything that you're seeing with the negative third quarter numbers and relating that into market movements higher that we should be looking at?
No, not necessarily. I mean, you hit the nail on the head, Michael. I mean, earnings estimates have been revised downward dramatically this third quarter, and historically, what that means is the street is effectively just lowering the bar for companies to beat. And companies historically beat close to 2/3 of the time. Mm-hmm. So a 66, 67% beat ratio is pretty normal. So you can make, I think, a pretty strong statement that we're not going to be down 3.2%, but somewhere less than that. But the year over year, 2018 was definitely a great year, but largely driven by the 2017 tax bill. Mm-hmm. So now in 2019, the year over year comps are pretty difficult, so that we're jumping over some pretty high 2018 numbers. So it's important that we do with you, Michael, and your firm is looking both at bottom line earnings, but also top line growth, mm-hmm. revenue growth specifically, and making sure that revenue growth doesn't significantly fall back, because that right there is going to be a direct reflection of really economic growth, both U.S. and global economic growth. We feel, again, still relatively okay, despite the bottom line red number for 3Q. We feel okay just in terms of the top line growth outlook here.
And it's also so interesting to me that it's always, and we always get back to this, it's always about the multiple expansion. Where are we going to get a multiple expansion? Are people going to be willing to pay more for earnings? And that is so key and critical for driving market performance. And that has a lot to do with that, people feeling good and their attitudes feeling strong about where we are. I also think it's a function of where else are you going to invest your money? And you can look at the bond market only so long and get only so excited about investing there. So it kind of naturally leads us back towards the market, and maybe we see some multiple expansion, which, a little bit of favorable earnings boost plus a multiple expansion, because where else are you going to invest, creates an interesting potential headwind going into the fourth quarter, I think.
Mm-hmm. Yeah, stocks, literally, they are historically cheap when you look at them relative to bonds. That's right. Number one. Absolutely historically cheap. And number two, that multiple expansion. Right now, the U.S. trading roughly 16 times. It is the most expensive market globally, but it's not that out of line, at all. So
right.
Returns from the equity market for a stock, come from one of three places. It comes from multiple expansion, okay, or contraction. So what happens to the PE multiple? It comes from earnings growth, okay, and then it comes from the dividend yield that you clip. A, B, and C. That's it. So great about the earnings year over year, but again, longer term we feel okay. Multiples, probably a little room to expand, and the dividend yield really doesn't change much. So that's why we're sort of sitting sort of at a moderate look right here.
Right. Well, are you ready to do a little bit of economics? I mean, I'm ready to do this. I've got economic data, and I don't want to get too bogged down in it because I went a little crazy this quarter. There was so much for me to dive into and grab. So I hope, Joe, you're ready. So we're gonna do this. We're gonna talk for a minute, and I don't want to get too deep into the weeds. So I'm gonna try to move through some of these things quickly because we could spend a half an hour on each item individually. But let me just kind of go high level here. I'm going to start with the ISM, manufacturing and non-manufacturing. We're trying to get a sense of whether or not the economy is growing from a both manufacturing and services point of view perspective in the United States. And what you'll see is that, again, if you haven't seen it, manufacturing has been in a steep decline and for the past couple of months has been in a contraction, meaning that the actual manufacturing industry has been shrinking a little bit here in the United States. At the same time, the non-manufacturing or the services sector, which again is the majority of our U.S. economy, is expanding, albeit at a rate that has come down sequentially, again, seemingly month after month with that manufacturing number. So what you see is a tale of two economies. One, the larger part of the U.S. economy, which is services, is still growing and is still expanding. No, it's not as high or the expansion isn't as great as it was several months ago. And manufacturing, which was expanding, again, sequentially month after month after month, even going back to 2018, we've seen that number continue to fall where the manufacturing side of the economy is shrinking. So, you look at that. See, the headline was, oh my gosh, manufacturing is, manufacturing recession, or you might have even seen a headline for recession. But before you get too worried, we are still a service-based economy and that part's expanding. Is there anything else that we should be reading into some of those data points, Joe?
I'd give a couple of color points. Number one, manufacturing cycles historically go in 3-year increments. They last roughly 3 years. And that includes the updraft and then the subsequent downdraft. And that's important because the current downdraft that we're seeing in the manufacturing side, this is globally, began in really the first half of 2018. So we're coming up to what would be a normal cyclical, inflection point on the manufacturing side. So I think there's a pretty strong case. We're hopeful that we might be closer to a bottom, certainly, and than a top on the downdraft side. That's number one. Number two, the ISM number that the market really threw a fit about last week. There's really two different baskets of manufacturing data that we look at. ISM data is survey data. So they actually go out technically. They go out and survey 300 companies in the U.S. And that's soft data. How do you feel about the environment? How do you feel about new orders? How do you feel about production? How do you feel about employment, et cetera? So that's soft data. How do you feel? The hard data on manufacturing right now isn't really reading the same way. The hard data is actually much more encouraging, and that's actual durable goods sales. How many widgets are being sold? And that is a much more constructive read. Right now, the 3-month over 3-month annualized change on durable goods sales is actually looking really strong and trending upward. So it's not quite as clear when you look at soft data versus hard data that the market should be too anxious about, the manufacturing recession. And the last point I'll say is the global manufacturing sector has been so overwhelmingly hit by what's happening in Europe. The European manufacturing sector, and specifically the auto sector in Germany, is really having an impact, as is the trade war. So I think there's some more transitory aspects behind this data, both hard data, well, it's mostly soft data, but also the hard data, I think, tells a little bit of a different story. So that's sort of how we're reading those tea leaves right now. Okay,
again, we're on the same page there. And when I look at the sum total of, the economic leading indicators, and it's things like the work week, it's jobless claims, consumer good orders, new orders index, non-defense capital spending, interest rate spread. If you look at all these different components and you add it up, there are still a number of positive leading economic indicators that are favorable for things continuing to move forward. And at the same time, it doesn't appear that many of those things are so nose-bleedingly, astronomically, just in a different stratosphere. Are they too high? No, nothing to me is screaming of this. This has got to be reversing. And I get back to the most important part of understanding the economic data, and that's the consumer. And the consumer, I'm looking at jobless claims, and I'm looking at employment, and the different measures of confidence and sentiment. And all of those components continue to be really strong. And it's critically important because the size of our U.S. consumption is greater than the entirety of just by consumers alone, is greater than the entirety of the Chinese economy. U.S. consumers are spending more than all the consumption for the government and people and businesses that China can muster all together. So consumer spending, when it's strong here, and confidence is still very good, sentiment is still very good, and again I mentioned the jobs numbers. So as long as people are continuing to spend and they have jobs, you gotta look at it. And without any other major warning signs, from leading indicators, as things continue to kind of gently move forward. Obviously, we're going to talk about some other potential pitfalls, but for me, I look at this gently rolling forward, given the economic tea leaves that I'm reading.
Yeah, I mean, the consumer definitely is in a good place, we think. I mean, the consumer balance sheet is one other thing I'd add, just in terms of the amount of debt or how levered the U.S. consumer is. And we, meaning the U.S. consumers, are very, very healthy from a leverage perspective. Number one, job market, no question, overwhelmingly strong. Obviously, everybody knows 50-year low unemployment rate right now. The nearer-term averages on the job market do start to show a little bit of sign of slowing down, a little deceleration, but overwhelmingly still very strong. Wage growth, as it feeds into the consumer wallet, has been decent. That number did slow a little bit in September, but still it was up 2.9% in September. So yeah, we're getting paid. We have jobs. Our balance sheet looks very good. That's dovetailing directly into housing market. Some pretty robust housing market indicators that we're seeing as well. More low mortgage rates factoring into that as well. So. I think the consumer, U.S. consumer, has definitely been the saving grace over the last couple of years, and we don't see any reason for that case to weaken.
Again, if people have the personal balance sheets to go ahead and borrow and spend and consume, again, the keys are going to be that when you're trying to think about investing if you're trying to look for an individual stock, the key is going to be for you is trying to figure out where those dollars are going. There was an interesting report this morning about where teens are spending. I don't know. For me, my ears perk up when I see any of those kind of stories, and I found it very interesting in that a lot of people want to draw conclusions, and that teen spending and really this millennial spending, Forever 21. Joe, I'm sure you were tuned into this when you saw it, but Forever 21 this morning continued to be one of the top 5 places or top 6 places where teens like to spend year over year over year over year, which I find interesting because you think as an investment thesis where jobs are good and wages are good, and you have this whole millennial push in terms of just where they are in the population distribution. You look to see where they're spending. They're spending in Forever 21, yet at the same time, Forever 21 declares bankruptcy. At the same time, you would think that there's just no way you can't possibly have both of those things. They're opposite ends of the spectrum, but it is interesting to me that again, your due diligence and research when you're doing it on an individual security has to go beyond just the demand. In fact, there was just a lot of things that about that particular store, that industry, that led to its challenging and very public demise. But Joe, I don't suppose you've ever even been into a Forever 21. Probably not.
I frequent the store once a week.
Okay, I didn't think so. I'm just saying. I wanted to throw it, and it's a nice anecdote for me. So let's kind of
Let me say one thing, actually. Mm-hmm. I think while we do share this research with your shop there, Michael, but that is Forever 21. Actually, I can tell you that it was added to the Death by Amazon research list about 3 years ago.
Yeah, it gets into the death of the mall and all that. Hey, can we do a little trade war, stuff? And you mentioned a little bit about Europe and the economic numbers. If you look at things, employment, and you're looking at economic output, you're seeing it continue to get worse quarter after quarter. We're going to look to see where Germany is this quarter, if they have a second quarter in a row of declining GDP. But the whole world is really wrapped up in this trade war cycle. It really isn't just reserved for China. So there's a couple things that I wanted to say on it. And then Joe, I need you to jump in. But with the trade war cycle, the thing that I find very interesting is that there's this Groundhog Day effect that's going on, where the administration will be tough on China, the market will then sell off, and then eventually the administration will hint at some kind of resolution, and then the market will rally. And then the rally in the stock market makes the administration currently feel, very bold enough for them to say we don't need progress, and then essentially they're tough on China again. The market sell off, and we go through this cycle over and over and over again. It feels like Groundhog Day. And today, as we speak, the market was down a couple hundred points before it opened this morning, because there's no longer this good feeling that when we meet with China in the next couple of weeks, that there's going to be a meaningful trade deal. And number one, I do want people to pay attention to the fact that there's a big part of the market that trades on these news algorithms. Meaning, when these Trump tariffs come, there's people that are really trying to time things and get in and out of the market based upon good feelings with China, which as a retail investor, I would not recommend it. It's a dangerous game to play, and there is a real financial impact in these trade negotiations with China, in that our year-over-year change in total trade with China, as of from July to July, we were down $54.5 billion in trade. And what I find interesting is that we've picked up $147 billion in trade with places like, most notably, Mexico, the Netherlands, South Korea, Vietnam, to lead others. So on one hand, the trade war is a lot of news, a noise with regards to the news. You hear a lot of and it creates a really difficult, seasick feeling if you pay attention to it and you try to trade into it. But at the same time, there is a real economic impact that's happening. There is something real that's going on, where the money is moving into different hands. So it's something to pay attention to. So Joe, I'm curious as to where your thoughts are on the trade war at this time, given kind of this whole host of information.
Yeah, well, I guess big picture, trade war is bad. It's bad for the global economy, just given the fact that it increases uncertainty on which business leaders need to make decisions. So it's pretty clear that it's got a negative economic impact, and therefore a negative financial market impact. And that's the stock market reacting to negative trade news, as it has for several months now. So those are pretty well established rules of the road, for sure. What does that mean? What we think it means is you really need to look at what the incentives are on both sides to get something done. And that's where we're starting to get a little bit more constructive certainly over the next 12 months. Because here in the U.S., the administration's being backed into an election in November of 2020. And the data, as well as polling, is pretty clear that the economic data, financial market data, is, as I just described. The polling also is extremely clear. Trump gets really high marks on the economy and his handling of the economy. He gets very low marks pretty much everywhere else. But the handling of the economy, he gets really, really high marks. Now, public approval or public polling on his handling of trade negotiations with China is overwhelmingly negative right now, with only 35% approval and 57% disapproval. And this is of course, across both sides of the aisle. And the impact of Trump's trade policies on the chance of recession also very pronounced. A 43% polling rate of an increased chance of recession given Trump's trade tactics, and a 16% ultimately brings something to a realization, political pressure to chalk up a victory, political pressure to keep the economy on track. I think that's ultimately the primary incentive, which in any political analysis, you need to look at what their options, what their incentives really are, and that's usually true north. And we feel like that's the case here with the trade war. So, again, the next couple of months, though, and today, as Michael just mentioned, no different. With some there's some talks scheduled to occur Thursday this week. I think there's still some more noise to be had before that November date really starts to materialize on the part of the administration.
And it's interesting. There was that B of A Merrill Lynch report that came out, and it was a survey of the big money managers and economists, and it's seemingly sudden. All of a sudden in September, the number one answer for when do you think the trade war will be resolved, the new number one answer is overwhelmingly that this is the new normal. And it was surprising enough to me to put it in our market outlook piece for this quarter, because the tariffs, what they do is they do put us on level and on par with the tariffs that China has had in place against the United States. So, we want to, we want to say, oh, this is going to be resolved. We're going to kind of go back to the way things were. And it seems to me that, there's been a leveling of the playing field of sorts. And in this, the market can go up if this is kind of the status quo, but it would be nice to see some kind of a situation where it's at least stable, because I think the market can do well if we have a stable environment. But I don't know if it necessarily means, Joe, that we just take away these tariffs that we've put in place.
Yeah, no, I mean, the questions like this are always tricky, because what does resolved mean? I would agree with this survey, by the way, because I agree it will not be resolved, quote, black and white, switch on, switch off. It will ultimately probably be a partial, quote, deal of some sort, with some tariffs, both sides remaining, but the issue removing itself from the headlines is really what the financial markets, are looking for, without question. And by the way, this feeds into 2020. Let's be really clear. Both the Republicans and the Democrats, both sides of the aisle at this point, are very much protectionist type posturing. So they're both very much protectionist. So even if the White House changes hands in November, don't expect the protectionism and all of a sudden global free trade to be back on the front burner.
Right.
At least at this point, it doesn't look that way.
Right. And well, I wish we could spend a half an hour on that. We're in concert on that. We agree. And one of the things I did want to touch on with the few remaining minutes that we have left here, Joe, is, you did talk about the environment for stocks, and in the environment for stocks that you're referring to is, how historically favorable to some degree it is. And I think this is what you mean, but you'll let me know. Some data that I found really compelling. 56% of stocks in the S&P 500 here, and the big 500 U.S.-based companies, those stocks have in that S&P 500, 56% of them have a yield. They pay more than the 10-year Treasury. And you say, well, how often does that happen? I've got data that goes back to 1990, and this is as high of a percentage that has been. It's higher than it was in 2008. It's higher than it was in 11 or 12. And then if you wanted to look at it another way, so that's 56% of stocks that have a greater yield than the 10-year Treasury, and 43% of stocks in the S&P 500 have a yield greater than the 30-year Treasury. So I look at this from a very simplistic standpoint, and that is, would you rather own the S&P 500 or a 10-year Treasury? And again, there's a lot of stocks. If you want to have a yield that's greater than the Treasury, pick a basket of those. And at some point, you would think over the next 10 years, the value of those companies hopefully will be higher, where the 10-year Treasury won't be moving. You're just hoping to clip your coupon. And again, the 30-year Treasury, with 43% of companies in the S&P 500 having a yield greater than the 30-year Treasury, Joe, Is this part of what you mean, that the stock valuations look particularly good relative to bonds?
This is exactly what I mean. When you break down I won't go too technical, but when you break down the risk premium, the expected return that you receive in investing in the stock relative to prevailing bond yields, it is extraordinarily high right now. That meaning the scales are tilted very much in favor of stocks relative to bonds. And this is probably the most poignant chart to really point that out.
Yeah, I thought so. It certainly jumped out at me. I do want to point out that we're noticing that we're within, we got all kinds of beeping. That would be, the camera. We're good. Okay, perfect. So I would say that, from a valuation standpoint, one of the trends that's existed for a really long time is that growth has performed better than value. Growth meaning, again, I want you to think just traditionally of your technology names versus the value side, which tend to be your companies that pay dividends, or tend to be your more well-established companies. We're seeing perhaps the point where it's been so outsized for so long, the growth performance versus value, that value may be something that you want to put a little bit of a tilt on. If you're looking for stock exposure, you're looking to reallocate, maybe this is the good time for you to start to move a little bit in that direction. So I did want to point that out. I also wanted to point out that the price of oil has been remarkable. There's been incredible consternation in the Middle East. There has been major supply disruptions in Saudi Arabia. With economic performance being okay, you would think that oil prices would be remarkably high, but oil prices are down about 12% or so this year. They're nowhere near where they were in 2008 and in 2011 and 12, where you had this $100 a barrel oil. So oil is even in a place where, for both businesses and consumers, it's inexpensive enough to not be something that's going to hamper our economic movement and recovery. So I see good signs there too. Is there anything else that you read on oil or any of those base commodities, Joe, that we should take and extrapolate for what we should be doing with our money?
I don't think so. No, I don't have too much to add there. I mean, oil's always has been and always will be influenced by, ultimately by global growth. So it's going to grow along the lines of global growth, number one. But number two, it's always susceptible to intermittent shocks. So we saw the drone attacks, in Saudi Arabia, really put a shock into the oil markets, which subsequently recovered. I mean, oil spiked 19% in a day. That was pretty historic, just more recently here. And then, moved on to recover most of that back pretty quickly after Saudi Arabia came back and brought their production online pretty quickly. So, no, it's the commodity prices. Again, I think the true north from a commodity price perspective and oil is really just global growth. So that's sort of how we read those.
Yeah, and I agree on that, and I do want to make sure there's two more things I want to hit real quick. The first is I did do a look into the past to see what impeachment does to the market. It seemed like this. I don't know how we can do this market outlook, Joe, without at least mentioning it. And we're not going to get political. We're not going to take sides, but we're right now in kind of this impeachment inquiry mode. There seems to be a lot of evidence mounting, and if you look at prior impeachment situations with both Nixon and Clinton, the market did not perform well. And it really depends upon how long it takes some of this information to come out. And, in the case of Nixon, the market performance was pretty dramatically negative from once the information started to break. And again, we had an oil embargo there too, which makes things a little bit messier economically speaking. So there was more going on than just the impeachment, but the market did not perform. And if you look at, from the moment where Monica Lewinsky admits to her relationship with President Clinton at the time, and then Clinton testifying before the grand jury, and the Starr report, and then when the House votes for the impeachment inquiry, the market there in that case didn't perform well. That was a real difficult, 6 or 7 month run there. So in terms of October volatility, if we're looking for something spooky in it, it seems like we got to pay attention to this impeachment inquiry and where it goes, because it may, if the market trades historically as it has in the past, may portend to some difficult trading days for us in between now and then, because the market does tend to hate uncertainty.
Yeah, well, looking at these two charts, and again, overwhelmingly, I think it's a little bit too early to handicap exactly what's going on, because it seems like new information is coming out every day. When I look at the Clinton impeachment, I think you can make a strong case that the Russian default on their debt and long-term capital dominated market movements more so than the impeachment hearings. I think, and that's, I think, the one thing that I'd urge everybody to keep an eye on here. The impeachment hearings are one thing, but overwhelmingly, it's going to be, trade negotiations and global growth. We think is going to be more dictating what the market does. We don't think the market's begun to price in much in the way of impeachment risk.
Right.
And when you talk about impeachment risk, I think you really just need to think through the first, second, third derivative, which would be, I guess technically would be a President Pence, potentially for a short while. If there's a convict, which I think is still far, far out of the cards at this point, if it's just an impeachment by the House and nothing more than that, this is all just political noise. If the Senate doesn't vote to convict, if the Senate votes to convict, and there's some early potential talking points there. I don't know where that goes, but if it did, I think that changes the game quite a bit, because I think that the Republicans certainly would have to scramble for a candidate for 2020, and would that candidate be able to beat an Elizabeth Warren or whoever the front runner is on the Democratic side? That starts to mean something, because I think the market overwhelmingly, I think, would probably favor more of a status quo handling of the economy, which the Republican side of the aisle has delivered more so than the market would appreciate more the very hands-on approaches that are being spouted on the left side of the aisle.
Oh, Joe, you're being very politically sensitive. Very well stated. You danced around that perfectly. So I did want to touch on one of the ways that we tend to find hedges with our clients. Certainly, right now is not through hedge funds. We don't. There are times in markets where we'll look that way, but right now we don't, and we tend to be in the municipal bond world. So I just wanted to touch on this real quick, and then we'll get to conclusions. And that is, we're looking at the expected rate of return of municipal bonds. And again, for us, municipal bonds provide a liquid. Again, we can get in, get out, sell it, buy it when we need to. At the same time, it tends to be the kind of investment that when the market sells off, they tend to hold their value, maybe even do a little bit better. The big question mark is always, well, gosh, what about interest rates? They're so low. And right now, the 10-year Treasury is right around 1.5 plus or minus a little bit, plus a bit today. What if the 10-year Treasury gets back up to 2.25? What if the 10-year Treasury goes down to 1.25? How can we expect to perform? And what I'm here to say is that if the 10-year Treasury were to roll up to 2.25, the expected rate of return on our muni bond portfolios, and that's a difficult situation for munis, meaning interest rates are rising, the value of our bonds are falling. We're expecting the year-over-year performance for municipal bonds to be still about 0.8%. We still expect them to be positive. If you think rates are going to be the same, we're expecting rate of return in munis to be 2.25, and if the 10-year Treasury drops, and mind you, there's a growing list of economists that I read and respect very much that are seeing a 10-year Treasury that's going to touch 1%. Some even think even less, as it's going to be dragged down and sucked in and pulled down by the other developed countries outside the United States with their negative interest rate environment. If the 10-year Treasury drops to 1.25, then maybe you see a year-over-year performance of munis of 3.1%. So we continue to like munis as a hedge, which brings us to the conclusion of where we are. Joe, wrapping it up. Again, from the way I look at it, we're constructive in that we're not completely out of the market, but we are here taking client dollars, and we are actively positioning it to take some risk off the table when the market's making highs. If we see an opportunity that is going to create itself, whether by tweet or by some kind of impeachment inquiry where the market sells off a bunch, we'll look at increasing our stock exposure, because largely and overall, we don't see the economy falling into any kind of major abyss here at this moment. So, Joe, how do you want to wrap up the conclusions in 40 seconds or less? No pressure.
Okay, I would say your move to rebalance the equity side of your portfolios in September, I think is going to look pretty good given the, let's call it, 2-month runway of potential volatility that we might be seeing here, number one, but keeping an eye on true north as we do with all our clients, including you, Michael, is the most important thing. So I think, we feel still moderately constructive, and with an eye on potential volatility uptick here in the near term. But I think that was a great run through, just sort of the tea leaves. And I appreciate you having me, as always, Michael. All
right, Joe. Thank you again. And thanks for listening to our fourth quarter market outlook again. If you need slides, and thank you for emailing me, I'm happy to send them out. It's info@hh-wm.com. You can always hit us on social media. Manage the funds. We're there. We're on Instagram. We're on Twitter. We're Facebook. There was probably more. I'm looking at Laurel. She thinks. No, those are all of them. We're everywhere. All right. Thank you so much. Take care and have a great quarter. Bye-bye. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities, member of FINRA and SIPC.